Why oil prices fell in the face of supply shock.
I'm Bob Stokes with Elliott Wave International.
Looking back on 2022, one of the biggest fears about oil was that prices would skyrocket even more than they did due to a disruption in supply from Russia. Of course, Russia has been a major world supplier of oil, but after Russia invaded Ukraine, many global financial institutions refused to back transactions involving Russian oil. So back in March of 2022, we had this headline from a major financial website: Oil market heads for biggest supply crisis in decades, with Russia's exports set to fall. Conventional wisdom says that a disruption in supply, let alone the biggest in decades, would lead to soaring oil prices. However, at the time that March headline published, NYMEX crude oil was trading around $115 a barrel, and prices have been in a downtrend for most of the time since, for almost a year now. In December, even the New York Times had a hard time explaining the disconnect. Oil prices dropped despite heightened sanctions on Russian crude. So what's going on? Well, Elliott Wave International has studied the historic price patterns of oil and has concluded that investors cannot count on a relationship between prices and the oil market's fundamentals. Indeed, Robert Prechter's Socioeconomic Theory of Finance provided historical analysis with this chart and commentary. The chart shows the annual ratio between consumption and production worldwide. Take a look at the three shaded trends on the graph. The huge surge in the ratio between 1980 and 1982, the biggest rise on the chart, did not cause the price of oil to rise. Rather, it fell a lot. Nor did the large decline in the ratio between 2002 and 2005 cause the price of oil to fall. Rather, it rose a lot. And the rapid plunge in the ratio during 2009 did not cause the price of oil to fall. Rather, it tripled. These extreme anomalies render the proposed causality spurious. What Elliott Wave International has observed is that oil's price does tend to follow Elliott wave patterns. As you probably know, Elliott waves reflect the repetitive patterns of investor psychology, the primary driver of financial markets. Using the Elliott wave model, our December global market perspective stated, crude should be at the forefront of a decline. Indeed, as of intraday on January 9th, NYMEX crude oil is trading lower than it was when the December global market perspective published. Now, the new January global market perspective offers more insight into what you can expect for oil's future price path. Learn what you need to know by following the link below this video.